Business leaders and visionaries, Kelly Kennedy here, bringing you exciting news about our newest sponsor, Foresight for IT. Based in Edmonton and backed by support partners across all major Canadian cities, Foresight for IT isn't just an IT service provider. They're your global IT ally. With remote support available worldwide, their full-circle approach to IT, from setup to support, security, and scalability, ensures your vital services are always up and running. Imagine having always-on technicians and business IT support plans that take the hassle of technology management off your desk and into the hands of experts. Whether you're in blue-collar industries, finance, law, or healthcare, Foresight for IT is the game changer you've been waiting for. Elevate your business globally with Foresight for IT. Visit www.foresightforit.com and let them know Kelly sent you. Once again, that's FORESIGHTFORIT.com. Foresight for IT, redefining IT experience. Thanks for listening to a word from our sponsor. Let's get back to the show. Welcome to episode 116 of the Business Development Podcast. And on today's expert guest interview, we are bringing you the managing director of the Georgian Angel Network, Michael Badham. Michael is going to teach us all about what angel investors are looking for and what ideal partnerships are made of. Stick with us. You are not going to want to miss this episode.
The great Mark Cuban once said, "Business happens over years and years. Value is measured in the total upside of a business relationship, not by how much you squeezed out in any one deal." And we couldn't agree more. This is the Business Development Podcast, based in Edmonton, Alberta, Canada, and broadcasting to the world. You'll get expert business development advice, tips and experiences, and you'll hear interviews with business owners, CEOs, and business development reps. You'll get actionable advice on how to grow business. Brought to you by Capital Business Development, capitalbd.ca. Let's do it. Welcome to the Business Development Podcast. And now your expert host, Kelly Kennedy.
Hello, welcome to episode 116 of the Business Development Podcast. And on today's expert guest interview, man, do we have a show for you. Today, we're chatting with Michael Badham. Michael Badham is a distinguished senior executive with a remarkable track record spanning over 4 decades, during which he has excelled in steering transactions across an extensive array of sectors within Canada. With a background in computer science, statistics, and financial analysis from the University of Waterloo, Badham's journey has been marked by key roles at prestigious firms, including partnerships at Deloitte, CCFL Advisory, Nesbitt Thompson, Power Financial Capital, and KPMG. His expertise encompasses a wide range of areas, including corporate finance, business and equity valuation, strategic planning, due diligence, M&A restructuring, executive training, and lecturing at Georgian College. Currently, Michael wears multiple hats, reflecting his commitment to fostering innovation and education. As the part-time managing director of the Georgian Angel Network, he plays a pivotal role in guiding investments and facilitating the growth of businesses with transformative innovations. Simultaneously, as the part-time executive director at the International Institute of Business Valuers, he spearheads efforts to deliver high-quality professional business valuation education globally. Additionally, as a partner with Strategy Tools, Badham contributes to empowering organizations globally through strategic facilitation workshops, utilizing modern tools and techniques. A founding shareholder of Hardwood Ski and Bike Inc., Michael Badham's journey exemplifies a fusion of academic brilliance, extensive corporate experience, and a profound commitment to shaping the future of business and education. As he continues to make meaningful contributions to various sectors, Michael Badham stands as a beacon of leadership and expertise, leaving an enduring impact on the Canadian business landscape. Michael, it's an absolute honor to have you on the Business Development Podcast today.
Well, thank you so much, Kelly. I'm not sure my mother could do as well as an introduction as that. Oh my gosh, thank you so much.
Congratulations on an absolutely stunning career.
Well, you reflected back on the University of Waterloo, and when I started in statistics and computers and mathematics, and I kind of left high school thinking, God, it's either reading, writing, or arithmetic, and I chose arithmetic, but I think as most people know, writing becomes really important, and of course, reading is still one of those skills that we still need to be able to learn what we do. So yeah.
Absolutely. Yeah. And, obviously we had our first meeting ahead of this, and we just totally hit it off. I absolutely loved that conversation with you. And when we kind of delved into investing, I was like, Michael, this is something that we have not touched on yet in over 100 episodes of the Business Development Podcast. We've dealt with people that do startups. We've dealt with mentors, but we have not touched on the investment side. And who better than you to do that? And then obviously there's some other things that we talked about as well with regards to simulation, which you guys are working on. That's super, super exciting. And I think will be the future for a lot of these startups in order to essentially test their ideas and learn ahead of the need. But what I would love to do before we get into that today is just if you could take us to the beginning and take us down your journey that led you on this path.
Well, as you mentioned, I started my career with KPMG in 1979, having graduated from the University of Waterloo, and was immediately funneled into the restructuring group because 1980 was a recession for us, and it was at a time when it was kind of all hands on deck. And I had some tremendous experience reorganizing and restructuring and liquidating and building various small businesses as a result of loan foreclosures and working for the banks. And in one of my sort of more interesting stories, I as a very young person, given kind of the reins of a small jewelry company that had 3 divisions. And over the course of 2 years, I liquidated one. I built one up well enough to sell, and continued to operate one until it had repaid the loans, and at which time we sold it. So that kind of early experience in dealing with small businesses really set me into an interest of how do we continue to build small businesses in Canada. I mean, there are the public markets, but the total revenues of public market companies only represent about half of the revenues of our North American economy, and the other half are in small business. We always say that small business is the backbone of the economy, and I just became really interested in how small businesses are financed, and that is really a struggle in Canada, and so that became kind of a focus throughout my career. And I moved from there. I became a partner at KPMG. From there, I moved to Financial Power Capital Corp, which was a small private equity group where we looked at making equity investments. And from there, I moved on to an investment banking, ultimately becoming a senior partner at Deloitte and ran their corporate finance and M&A practice for many years. When we had the financial crisis in 2009, I left Deloitte, and it was also the time in which the iPad was coming out. And I just decided to go on a journey of technology and iPads. And Canada was really transitioning from a resource economy to a startup economy. And again, I began to think, well, capital, particularly for startups, is the fuel that gets these businesses going, that helps entrepreneurs take their idea or their development from innovation to commercialization. And so I started working with all kinds of small businesses in a whole range of sectors. And in 2017 took over the managing directorship of the Georgian Angel Network, which was one of 16 angel groups in Southern Ontario, and a number of angel groups all across Canada. And these groups we all collectively work to connect high net worth accredited investors with startup investment opportunities. And it's interesting that my career has collided with this, because this is about the most fun that I can have. And, basically I look at 20 things a month. I have to screen them down to the 2 that I think are of most interest to our investors. And they pitch to the investors in an investor meeting. And from there, we follow up as to who's interested. And we go, 8 investor meetings a year. Most of the groups in Southern Ontario are supported by the federal government for admin costs. We charge membership fees to our members, of course. And so over the Georgian Angel Network was started in 2012, and I took over in 2017, as I said. But our members, our 30, on average, 30 active members over the last 10 years have invested in over 75 companies and have put out just over $25 million. So that's money out of people's pockets directly into the economy. We've seen some successes. We've seen a lot of failures. But it's absolutely fascinating as to what the young people are doing today in our economy in terms of transitioning to digital platforms and new inventions and new innovations across all industries, all spectrums. It's really fascinating.
Wow. Yeah, that's amazing. First off, and it does sound super fun, actually, from a job standpoint. How did you end up, the managing director?
Well, it's a small organization, right? So it was an interview process. It was actually the managing director before me was a colleague of mine, Sandy Robertson, and he reached out to me and said he would be retiring, and there was a search committee on, and I had been teaching corporate finance at Georgian College. I'm based in Barrie, Ontario. And so a few people knew me, and I went through the interview process and landed the position. And it's interesting because, it is a combination of education and investment. We do a lot of workshops helping people who are interested in making angel investments learn how to do it, to the best of their abilities. And as you know, when we spoke previously, angel investing, you need a portfolio approach to it. You're going to make 10 to 20 investments over a 5-year, 10-year period.
Yeah.
And, on average, and it doesn't actually matter. When you look at the statistics, the very best angel investors probably only have a track record of 2 or 3 out of 10 being successful. And so there's some interesting strategies that people use to find good opportunities, to screen them, to do the due diligence for them, and to actually then invest in them and then help them grow. And also apply a portfolio strategy to their investments to be as diversified as possible, to give them the best chance of success.
It sounds incredibly challenging to pick a winner.
Well, you can always just sit back and do the spray and pray model, right?
Yeah.
And there's nothing wrong with that. You just say, you know what, these are the few that I like. I like the people. I like the idea. I get it. And I'll just invest. But it turns out that the most successful investments are those in which you add a bit of your knowledge, a bit of your connections. You can make good introductions. You can help the founders take their businesses to the next level, right?
Yeah. Yeah, no, for sure, for sure. And it does seem like something like that does take a lot of research. I imagine that when you're vetting these companies, there's a lot of onus on you to really do your diligence and make sure that it's done perfectly by the rest of the group, I would imagine. Can you explain to me what that process is like for you to go from, or first, maybe what are the criteria that you would start with?
So I do have a selection committee that I work with, and all the angel groups are different. Everybody does it slightly differently. In the case of Georgian Angel Network, the selection committee has an advisory role with me. They help me, but they put the onus on me to actually make the picks. In other organizations, there's a more active involvement by the members, and the managing director has more of an administrative role than a decision making role. But I apply what I call the 7 T's in order to clear the first hurdle, where I talk about team, who are these people? What are their backgrounds? Why are they passionate about this? I talk about traction in the marketplace. What are the level of sales that they have? And are their sales growing, and how are they obtaining that traction? We talk about, I use a T called terrain for the overall size of the market. We're not good at small niche market businesses. We want to see businesses that have really large total addressable markets, or TAMs, with very large, specifically addressable markets that they can get after right away. And when we generally, there's a lot of research, so we generally think about total addressable markets in excess of $1 billion. And in fact, really the benchmark is 10 billion. So that if you even get just 1% of that market, you'll have a sizable business, and therefore a good opportunity for investors. Other T's we call the terms of the deal. So we want to make sure that the deal basically fits the angel investing seed or pre-seed stage model. We've gone through a period the last couple of years where valuations have gone down. And for the first part of 2023, it was if the founder community in Canada hadn't got the memo that values were down. And so I could screen a company out just by saying, so what kind of valuation are you offering investors for today? And they would give me a number that was just way too large. I said, you know what? I don't really even need to know much about your business. You're not fitting our mold right now. Right?
Sure.
Other parts of terms have to do with a focus that we have at Georgian Angel Network in climate tech and in B2B transformational opportunities. We don't do very well on the B2C consumer products, although we have seen a number of them, which have been sort of interesting. From golf bags with magnetic plates embedded in them, so that your magnetic phones and other devices or rangefinders can just snap onto the bag very, very conveniently.
That is
to a Strava-like app that tracks you for your sailing. So if you think about, Strava for running or cycling, here's a device that will track for sailing. And so we do from time to time look at consumer products, but most of our products are B2B type innovations. And then thirdly, we look at the health tech, med tech space. And recently we've been collaborating with RVH, a large hospital in our region, which is building an innovation center to help promote the health tech, med tech innovations that they're looking at. So again, screening within that, there are some oddly funny screening, like you have to be able to attend our meeting, right? I can't schedule our members. Our meeting date is fixed, so it's kind of funny. I can say, "Are you available on X date?" And if they're not available, there's no really point in having the conversation. It's kind of funny that way. So, and then it's just a question of going down, deeper into each of those areas, and making sure that they have all of the documents in a way that I can send them to our members easily, that they've got a data room set up, that they've got a one-pager, that they've got a presentation that, will cover all of the key issues within 20 minutes. Our format for our meetings is we do 20 minutes of presentation, 20 minutes of Q&A, and then we go in camera as a membership group for 15 or so minutes, and then we invite the founder back for some follow-up questions. So they have to be able to fit that mold. But yeah, and then we're, again, I could go through some of the things we've been looking at. We've done some water testing equipment that is really innovative for a company out of Edmonton, actually, that we invested in a couple of years ago. We're currently looking at some immersive theater type technologies. Your listeners are probably aware of the Sphere in Vegas. There are all sorts of immersive light theaters that are being built all around the world. And these theaters or locations will need content. They'll need active 3D light show content. So
Yeah.
we're currently looking at investing in a company that produces it. They're Emmy award winning producers, and they produce this kind of entertaining, immersive experience. So we're currently looking at that as well. So you can see the whole range from, and then in the medical devices, we've looked at some, at our annual winter summit, we looked at a device that you would wear on your hand that would, if you had some kind of tremor in your hand as a result of, say, Parkinson's, and you were unable to hold a cup of water without spilling it on yourself, here's a wristband that you wear that uses the same kind of anti-tremor technology that they use on buildings in earthquake zones, where the device reads the tremor, measures the tremor, and then issues a tremor in exactly the opposite cycle to prevent your hand from shaking. And
Wow.
it's absolutely incredible to wear this, because you try and shake your hand and it won't shake. Like the wristband prevents it from shaking. So
Oh, man.
truly remarkable innovations that are out there, that we look at, right? So
I was going to say, I'm a little jealous because you guys get to see tech so far ahead of the rest of us that you have a pulse on what the future is way ahead of the consumer public.
my favorite line at investor meetings is, "And now for something completely different."
Yeah.
You know,
Yeah,
absolutely.
it is amazing. It is amazing and super exciting. And, I guess one of the questions that I have is we probably have a lot of founders listening to this who just don't really understand yet how investment works. And I know we have a lot of listeners because, I'm one of them. We had this conversation. I'm like, teach me, Michael, how does this world work? Because unless you're a part of it, I think it can be really hard to understand. And one of my goals with the Business Development Podcast has been to have Edmonton Unlimited come on, Alberta Innovates come on, and really just educate people about how the investment ecosystem works within Canada. But this is a big missing side. And like I said, I'm really excited to have you on today to be able to really explain to our listeners what are the different types of financing? What is angel investing versus venture capital? What are the seeding stages? If you could maybe just run us through essentially a 101 on tech investment.
Yeah, sure. But let me also say that one of my screening questions, is are you as a founder team involved in some kind of accelerator or incubator in Canada? Because the startup community all across Canada, and in the Maritimes, in Quebec, Ontario, and I was recently in Alberta, and I know there is all kinds of really interesting activity in Calgary and Edmonton that are emerging, and there's certainly in Vancouver. The so these accelerators or incubators are great places for founders to go and learn, register in their program, and start learning about it. But if you think about the life cycle of a startup business, you're a founder, you've gotten an idea, and you're going to go first to your family and friends, and you're going to say, "I've got this idea. I'm doing it as kind of a part-time gig right now, but I've got a couple of partners," and you're going to do it, all through the night, as a side hack. You're going to find some low cost sources of either the materials or the designs, or you're going to, get some software developers to work with you. And you're going to basically build the software and the hardware. And you're going to do it at nights in your garage, basically. And you're going to bump along for a couple of years. And then you're going to get to a stage where you have kind of a minimally viable product or an MVP. And at this point, you're going to say, now, I need to be able to spend some money on getting something that's a little more than, scotch tape and Band-Aids and holding this thing together. And you're going to raise what we call a pre-seed round of financing. And that might be from a couple of friends. It might be from an incubator or accelerator that you sign up with that says, look, if you get accepted or enrolled in our program, we'll invest a little bit of cash to get you to the next level. You want to use all of that cash on your product. You don't want to spend money on lawyers and accountants and IP. You basically, keep that, together as best as you can, but you try and get your product into a place where you can start working on product market fit. What what feedback are you getting from your customers? And you go on a very rough journey to achieve what we call product market fit. You're going to pivot your product. You're going to take features off it. You're going to add new features, but you're basically soliciting feedback from your target customer. And when you get product market fit, when you really can see that if I could make more of these, if I could offer my software, if I could get this into customers' hands, they would pay for it. As soon as you get to that stage, you're ready for angel investment. And a typical angel round of financing is somewhere between $500,000 and $1.5 million. And you're going to give up probably 20% of the equity for that amount of money. And it'll be less if you're raising 500, and it'll be more if you're raising $1.5 million. And it's interesting because everybody uses the phrase pre-money valuation, and it's not really a valuation of the company, because we all know that probably the true fair market value as defined is probably close to zero. You may have a little bit of kicking around in some value, but what it really represents is sharing the value between the founder and their sweat equity and the investors and their money. And it's that really interesting debate around which is worth more, the money or the sweat equity and the idea and the design. And the answer is you need both. Because the investors aren't going to work on this. They're only going to be investors. And the founders really need money to get it to the next level. The 80-20 split at the angel investment stage, and I'm just being very broad because it can be much, much less than that. And sometimes it can be a little bit more. But the split is really based on how many rounds of financing do you think you will need going forward. And so when we talk about a financial plan, it's not just a budget of revenues less expenses, but it's also a development budget. So if I were to actually get this innovation into the market and market it, how many tens or hundreds of millions of dollars will I need to get this product into the market? And therefore you sort of lay out what your capital raising strategy will be, 10 years into the future. And what we look for as angel investors is to make sure that the founder doesn't get so diluted by the venture capital rounds going forward that there's nothing left for them at the end of the day. And that's, oddly enough, if you think it's hard at the beginning, it gets really hard later on. And you just don't want the founders throwing up their hands and going, I can't do this anymore. Like, I'm just going to sell.
Yeah.
And it's because we drive too hard a deal at the beginning that founders just throw up their hands and say, well, just let me sell it to Google. I'm out of here. And we often complain, why are so many founders selling their businesses to the U.S. companies? And it's because we were a little greedy at the beginning, and we should have been a little bit more jealous, and we could have kept it here. And, there's a whole policy discussion we can have around that. And the other thing, we view angel investing as a bit like a relay race where we take the baton from family and friends and we pass it on to early stage VCs. And so once you've got market traction, once you've done that angel round, venture capital companies are quite interested in scaling you up to the next level. But I'm always aware of what VCs are looking for. And again, part of my screening process is to go to a couple of my close VC relationships and say, yeah, if we put $1 million into this company and they hit these following milestones in the next year, is this something that you would look at? And if they say yes, then it really gives us the opportunity to pass that baton on to the next level.
I see.
Once a company has got that VC round of financing, then they're well on their way. They may pivot a little bit. They may refocus some of their product market fit, but they're in growth stage now. And When they're in growth stage, they might do multiple rounds of VC financing, Series A, Series B, Series C. And at some point, they're going to either go with a strategic partner, they're going to go to a private equity fund, or ultimately they may become part of a public company, either on their own or being bought by a large public company. So that's kind of the life cycle from pre-seed all the way to what we would call exit.
Okay. That's really, really interesting. So it's all fitted together. And actually, there's a relationship all the way down the line. Like you said, from your initial relationship with the founders to make sure that they're looked after and that they're getting what they need to do, to then, after your pre-seed, the relationship, or sorry, your angel investment, your relationship then with the venture capitalists to make sure that they're also looked after, and that it's all about the relationship, and you're involved really on both sides. I didn't know that.
Yeah, so think about the life cycle from family and friends to pre-seed, early stage angel, to a seed round with angel investors, to an early round with VCs, to then a Series A, Series B, and so on. Now, the line is never so linear. It's never so smooth, right? So what happens is an angel or a company may do a Series A, and then something may not go perfectly well, and they have to come back and do a second round with their VCs. Or that we do an angel round, and it's not quite enough to get the VCs interested, so they come back for a second angel round.
I see.
There's a lot of bumps along the way as they go through that growth cycle, that life cycle, right?
Okay. So you had mentioned something earlier that I found really interesting, and you had mentioned that within Canada, the valuations have been really high. Why do you think that is?
I don't know that the valuations in Canada have been really high. They had been higher, and we're coming down as a result of the public markets coming down in 2023. We generally, founders will say that the valuations in the U.S. are higher than they are in Canada. And so, one of these sort of unfortunate things that happens is that founders will come to us and say, here's our plan, here's where we are with product market fit, and we think we have a pre-money valuation of 20 million. And I'll look at it and say, I think that's closer to 5 or 6 million. And they'll say something like, well, I've been down to Silicon Valley. They get it. They think I'm worth 20. You guys just don't get it here. And, that's an unfortunate discussion that, I have to say, well, when you come back from Silicon Valley and you think that we can help, please don't hesitate to call me, right? But we would typically see for early product market fit companies valuations in the range of 5 to 10. And as I say, they came down a little bit in 2023. We think that as the public markets get stronger, valuations are bottoming out right now, and I think people are a little bit more confident. Again, the number is not the value of your business. The number is really the sharing of the future value of the company, right?
Yeah.
And again, when we do our math, and we say, okay, in 10 years, if this is a business with $100 million in sales and it has a market value that we can sell it to a large strategic company for, call it 200 million. What are we getting for the $1 million we put in as angel investors way back when? And we like to get, 20, 30, 40 times our money. So we want to be able to make sure that our $1 million that went in, is going to be worth, let's call it 40 or $50 million on the way out. So if it's a 200 million or $300 million valuation, we got to be looking for 20% of it. And that's, after dilution from, Series A and Series B and Series C, because we will get diluted over time, right?
Sure.
So we really start to map out what that looks like going forward. And that's, once I sit down with founders and I say, well, let's do a capital plan for the next 5 years. What's that going to look like? How much do you get diluted? How much do we get diluted? What do the VCs take? Then you begin to see some rationality in the discussion, and we can lay out an appropriate plan, right? And that's what I say. These are the sorts of things that your listeners, your founders, will get expertise at the various accelerators and incubators, right?
They will. I agree. But I honestly think the expertise that you have is actually more helpful, because at the end of the day, you're the one buying them, not the mentors at the startups or the accelerator runners, right? They're hoping that you guys will buy them after. And so I think your information and your guidance is actually probably more valuable for that very reason.
Right. And I spend a good portion of my time giving workshops at various accelerators and incubators. And again, we'll talk about this at another time, but this is how I got into the simulation business, because we, we wouldn't teach a pilot to fly a plane by saying, here, take the keys and practice your landings, right? Like, we wouldn't do that. But we expect young people to graduate from university, give up the 2 or 3 best years of their life and say, hey, go start up a company. Don't worry, fail. It doesn't matter. Well, I'm telling you, failure is PTSD stuff. Like, you don't want to do that. And so we built this simulator that allows you to experience over a 2 or 3 day period all of the ups and downs of starting a business and raising capital and building your team and your product and all of that. And like all hands-on learning, it's really much better than, you don't teach a kid to ride a bicycle with a PowerPoint and a checklist. You say, here, let me put some training wheels on you and let's go, right? And it's the same with pilots. And as I say, we've had a lot of success with this scale-up simulator for helping founders really understand what it's going to be like, right?
Yes. And I'm really excited about that. And just so that all of our listeners know, there will be a follow-up show to this, probably in 2 to 3 weeks, that we're really going to delve deep into that simulation, because I do think it's very valuable.
So one of the things that makes angel investors successful is their ability to add value to the founders. And this is an area that I'm starting to focus more and more of my time on, because many angel investors just want to invest their money and then let the founders go. And many founders aren't actually that keen on having angel investors involved in their business, not because they don't want them, but because it's really hard for them to tell who's right when they're getting advice from people. And it's almost like one of the most difficult challenges founders face is determining who their advisors will be. And often they're so interested in getting advisors that they'll take anybody. Right? But actually they have to spend some time with their advisors, with their mentors, figuring out, are these people that I really can gain good knowledge from or not? And there's a bit of a skill set there in finding good people. And it's also part of a skill set in founders in finding good partners. You can imagine that over the years, I've seen a number of founder partnerships dissolve because they just didn't work out as good partners. And these are things that we tend to overlook a little bit in our business school, right? We teach the hard issues of finance but we don't necessarily talk about the people issues. We talk a lot about branding and marketing and product development and product innovation. We got those covered. We talk about finance, but the human issues of teamwork and mentoring and coaching is an area that I find quite interesting as well, because a lot of the mentors that are in incubators and accelerators are very successful people, but they've not developed themselves into the true mentors in the Socrates model, right? They're not taking their mentorship to the next level. They're saying, well, based on my experience, this is what I did. And often, Kelly, I'm not sure if it wasn't just luck, right, in the end of the day. And now we're passing luck onto these founders as if it should be transferable. So it is another area that I'm starting to work on in terms of helping business mentors become better at mentoring their founders, right?
Well, I can see that, especially from your stance, anything that you can do to give them an edge or give them a benefit benefits both parties. And so to me, it seems obvious that that would be a path that you would definitely want to venture down. You've talked on the importance of trust, especially, between your investors and the founders. Do you have any advice on how, both can do better at establishing that relationship?
Time together is probably the number one thing. And we want to move quickly. We want to invest our money quickly. The investors are used to a wealth management model where they talk to their wealth manager, their financial advisor, who says, look, buy XYZ shares. I can get them on the stock exchange at this price. We can do the trade today. It's fairly simple, right? Because you can trade in and out of it. If you don't like it 2 weeks from now, sell it, and you make a little or lose a little. It doesn't much matter if you're in a diversified portfolio of some size. But on these one-to-one investments, where you're likely going to make $25,000 investments over a 3-year period, the founders want you to move quickly. They want to raise the money. You want to move quickly because you don't want to be spending a whole lot of time on each one. But there is a need to have a number of follow-up calls, to do a number of deeper dives, and even a follow-up meeting to establish that true understanding between two human beings as to how this relationship will work. And remember, it is a relay race. So we're going to take the baton, but we are going to pass it on, right? We are going to say at some point, you're going to leave our sphere and you're going to go to a VC sphere. We'll always be here for you, but we want you to move on to the next stage of financing. So, the best people that I've met who are the best at hiring C-level, C-suite people, talk about it takes 6 dinners to hire a CEO, right? And that kind of thing. It's just about investing the time together. And that runs contrary to both sides. The founder doesn't want to spend the time and the investors don't want to spend the time, but they really need to. And
They need to.
And we're finding it in this world of Zoom meetings that we need to have more of them rather than fewer of them, right? And we really need to work those. But it means being more selective with your investments and putting a little bit more time into each one.
But it makes a lot of sense. And especially when the risk, your risk, I imagine, is quite high. When I heard you talking about, just investing in stocks, for instance, like you said, if that investment goes south or, you're not liking it for whatever reason, you can get out like that. With something like this angel investing, I imagine that it's more challenging to get out of. And so you need to make sure that you really like this company before you're going to put your hard-earned money into it.
Yeah. I mean, it's actually almost impossible to get out of it. And even from a tax point of view, if you want to write off your $25,000, the CRA requires you to provide some evidence that the company actually went bankrupt or is closed. And that evidence is actually hard to get, right? Because it may take another couple of years for the lawyers actually to wind everything up. So it becomes a little frustrating at sometimes that you can't even get the write-off for having made a bad investment for a couple of years. It doesn't happen that quickly. And at the same time, you can't spend forever trying to make a decision where that, at least half of your 10 investments aren't going to make it. And so you can't decide, spend so much time that the founders have to find financing somewhere else, or you're just, incapable of making that decision. You have to be able to make the investment decision. So you have to have a level in each of the 7 criteria that I talked about earlier, where you can say, okay, that's good enough now. We're ready to go, right? And we're also talking a lot about strategies that involve putting in a little bit less money into more companies, but then having another round of angel investment ready, so that if you put a smaller amount of money in 10 businesses and only 3 of them start to look good, then let's put some more money in those 3. And there's a great book called The Power Law of investing that really says focus on the winners. Put a little bit less in each initial investment, and then start putting more in the ones that are doing well. And so we're starting to look at that kind of model as well.
And that makes a lot of sense. And, you know, as we're going down this understanding of essentially the risks that you take, one of the questions that comes to my mind is, what can founders do to reduce the risk for you making their investment more valuable?
So, you know, there's what we call being angel ready, and there's like lots of places you can search up for the 15 steps to be angel ready. But probably the number one issue that we're finding is communicate with the investors, give them regular monthly updates. It turns out that the businesses that we've invested in that our investors are most interested in are the ones where we get an update every 2 months. It doesn't have to be every month, but it's kind of like there's a regular update. There's a regular flow of communication. And that provides an opportunity for the investors to say, oh, wait a minute, I think I can help here, or I can connect them. And the help is really connecting with other people, with other advisors, with customers, with suppliers. So the more information the founder shares about their struggles with the investors, the more opportunity the investors have to help. And they're not, the investors are very busy people, so they're not sitting around going, gee, I wonder how I can help them with they're kind of waiting for a question. They're waiting for it to be asked, right? So probably the number one thing I think is communicate, and provide investor updates.
That makes a lot of sense. Is there anything that they could do on that valuation stage to help to get them into something that makes more sense? I mean, obviously, like you said, going to the States and doing your valuation there doesn't make sense for a Canadian company. Do you have any advice there on how they can maybe come to a number that is like, oh yeah, that actually makes sense?
So it's all about product market fit. It's at the seed stage. It's all about proving that customers really want to pay for your product. So we have a definition of product market fit that goes something like, you've got a product that is so good that your customers spontaneously want to tell their friends about it. Right? And so, you've had products like that, I'm sure, right?
Of course.
And I can name 2 or 3 of them if you want, but they're just like the piece of software that is just so darn good, I have to tell my friends about it, right?
Absolutely.
And so that's the bar we want to apply. And founders sometimes believe in themselves too much. They don't put themselves in their customers' shoes and say, why are my customers not buying this? Why are they only buying it a little bit? Why aren't they spontaneously telling their friends about it? And one of our members is very, very good at getting the founders to say, well, why don't you follow up with the customers that said no to you and find out why they said no? And don't take the first answer, drill down, ask that why question 5 times to drill down, and then start to look at your product and its features and begin to adapt them. So I would say that founders who want the highest valuation for their product are the ones that can really lay out the data and their processes and the feedback they've had from their key customers as to why the customers like the product and why they chose not to get the product. Those are the ones that I think differentiate themselves in terms of the ability to scale it up. Because once you have product market fit, then you're going to use the angel money to begin to develop a sales process that doesn't require one-on-one conversations between the founder and the customer, because you can't scale that business. You have to say, okay, am I building a sales force? Am I selling through distributors? Am I doing this online with chat bots? How am I actually going to get my customers to buy this product without me having a conversation? I mean, think about the evolution of airline tickets. You used to phone a travel agent, you used to phone the airline, and think of all the friction. And now you just go online and you do it yourself. And if you ever talk to somebody, actually, if you ever even print out a piece of paper anymore, it's backward, it seems, right? You just buy the ticket, put it on your phone, and start the process of marching through security. It isn't a sense, with the airline, it's frictionless, right?
Yeah.
And so we look for people to get their product to that kind of level, and that's what earns you higher valuations.
I see. I see. Do you guys get any support from the government to protect you in any of these investments?
So, in different provinces across Canada, there are different tax benefits. British Columbia has an incentive that they provide for angel investors who make qualifying investments. They'll get a portion of their investment as a tax credit. Um, many of the angel groups, and certainly the ones in Ontario, all get financial support for our admin costs through FedDev in Southern Ontario, and I think it's Western Diversification in Canada, in the West, and I think there is a maritime group as well. So the government, provides some coverage for our costs in getting all of this done, which keeps the membership fees a little lower.
I see.
Um, for our members. But there is talk of, in Ontario, I know the groups have pitched the government to have some kind of tax credit for investors. If you just think of the economics of it, they're fairly strong, right? For every $1 million that goes in, that comes out of high net worth individuals' pockets and goes into a founder's business, most of that $1 million is spent on payroll in Canada, which is taxable, right? So a
Yeah.
portion of that money flows back as revenue to the federal and provincial governments. And if
Yes.
if they were to look at that, it's a fairly interesting economic model where and I pick a number. If $1 million, if 80% of $1 million goes into payroll, so 800,000, and that's taxed at an average 25% level. There's $200,000 of that million went right back into federal and provincial tax coffers. Well,
Yeah.
if I were in the government, I'd be looking at that going, that's a pretty good model. How can I encourage high net worth individuals to invest more, right?
Yes.
So I keep
Yes.
their, how do I do more of that? Because that's earning me money, right?
Yeah.
So there is and so they do support incubators and accelerators. They do support angel groups. There's a lot of that going on, right? And would a tax credit help? All of this helps, right? It all helps, and I think it actually, is one of the reasons why the Canadian economy is as strong as it is. There's just a huge startup ecosystem all across the country. And remember, we're competing globally for smart people to come to Canada, and for the people in Canada to, quit their job and start innovating and starting up businesses. Remembering that, at least 50% of the economy, but on a revenue basis, is small and private businesses. Right?
Yes. Yes. I imagine that we're probably talking to quite a few high net worth individuals right now who maybe are not investing yet in companies through angel networks or anything like that. Would you like to speak to them for a moment?
Well, absolutely, and if you're interested in learning, and I think Kelly, you said this earlier, it is fascinating to attend investor meetings and see what is being innovated, whether it's in clean tech or health tech or B2B. There's huge, great ideas out there, and we're seeing them at a very early stage. If this is of interest to you, I suggest reaching out to your local angel group and attending some meetings. And I know most angel groups, are fairly open to having people attend as a guest for a couple of meetings before putting out some money into membership. Our membership dues are not that high. Most of the groups charge between $1,000 and $1,500 a year to attend 6 to 8 meetings, and you usually get a lunch or a dinner out of it. So it's not, it's a pretty good opportunity to network with other people, learn about businesses, and learn more about making investments in private businesses. There's also a lot of education that we could be doing to the next generation of investors, and this is a group that I've started to speak with, because you can imagine that the age of our members is probably older than you think. And if you think about angel investing as taking 5 to 10 years to mature, a lot of these people are making angel investors for their next generation. And so we've started to think about the next generation of people managing family wealth and family offices and saying, if you're in your 30s or 40s and you want to know more about making private investments, you think you're going to be part of an intergenerational transfer over the next 10 years, there's an opportunity to join the ecosystem, learn about these things, and be able to contribute to the management of your family wealth going forward. So it's a great opportunity to think about making investments in private businesses.
Yeah, I think it makes a lot of sense. And I think there's a lot of people too, especially high net worth individuals, that maybe are just not quite sure what to do with that money. It can feel like there's not a lot of good options available. And I think this one does sound like, especially if you can get the right company and build that relationship, to maybe be one of the safer ones underneath that situation.
Any portfolio diversification strategy should include some investment in what are referred to as alternative assets. And angel and venture capital investing in alternative assets is, should be 5 to 10% of your portfolio. So yeah, and nobody really, joining an angel group, joining a peer group is really the best way to do it.
Awesome. Michael, that takes us to the end of our show. I just wanted to say amazing. Thank you so much. This was incredibly educational. I think you've helped thousands and thousands of people with your knowledge. And I'm really, really looking forward to having you back to talk about strategy tools and how we're going to help, the next generation of founders.
Kelly, it's been a great conversation. You get me so excited. I'm just bursting with energy here. So I look forward to our next conversation, my friend.
Amazing. This has been episode 116 of the Business Development Podcast. We've been chatting with Michael Badham, Managing Director of the Georgian Angel Network out of Ontario. It's been an absolute pleasure, Michael, and looking forward to having you back. Until next time, this has been the Business Development Podcast, and we will catch you on the flip side.
This has been the Business Development Podcast with Kelly Kennedy. Kelly has 15 years in sales and business development experience within the Alberta oil and gas industry and founded his own business development firm in 2020. His passion and his specialization is in customer relationship generation and business development. The show is brought to you by Capital Business Development, your business development specialists. For more, we invite you to the website at www.capitalbd.ca. See you next time on the Business Development Podcast.
Calling all office leaders and game changers. Score big this season with At-Work Office Furniture, your winning strategy for workspace excellence. Picture this: premium commercial furniture delivering a championship-level experience. From rapid deliveries to custom visual plans, At-Work ensures every piece is an all-star player. For over 40 years, At-Work has been crafting office success stories across Canada. Need a winning team without the hefty price tag? Head over to www.atwork.ca. They are not just furnishing offices, they're creating spaces where business champions thrive. Contact Rodney and his team at hello@atwork.ca. Mention Kelly and the Business Development Podcast for an exclusive touch. Your victory starts here at At-Work, where every workspace transforms into the ultimate arena for success. Don't just dream it, achieve it with At-Work Office Furniture. That's www.atwork.ca.